500 years ago, the merchants of Venice invented accounting. They wanted to record all of their business transactions as they imported goods from Asia and exported goods from Europe. Today, accounting has come a very long way. Professional organizations have established generally accepted accounting principles. Today's lecture will not be about teaching entrepreneurs how to be expert accountants. Rather, it's simply about trying to understand, construct, and interpret financial statements. Let us begin by assuming that an entrepreneur has set up ABC Corporation. Now, a corporation is a separate legal personality created by law. It can sue and be sued. It can actually own assets. It can owe money and repay that money. In this corporation, let us assume that it owns everything between these two enclosed lines. These are called the assets of the corporation, or everything it owns. But at the beginning, the corporation has nothing. At the beginning, there will be stockholders who will give cash to the corporation. In exchange for the cash, equity shares are given to the stockholders or the owners. The agreement between the stockholders and ABC Corporation is this: all of the profits and losses of ABC Corporation will go to the stockholders in exchange for the cash that they have given. So the first transaction is the stockholders give cash and shares are issued to the stockholders. Secondly, ABC Corporation may need more money and borrows this from banks or other financial institutions. The banks give loans for which the corporation will have to pay back in terms of principals and in terms of interest expenses. If we assume that ABC Corporation is a manufacturing concern, then there will be a third source of funds, and these are the suppliers. The suppliers would give raw materials and/or supplies to ABC Corporation, and they will be paid later. From the cash of the corporation, it may want to invest in land, building, machinery, equipment, furniture, fixtures, and vehicles. It will then try to activate the factory by converting the raw materials into finished goods. While in the factory, however, the corporation would need power and water, which they will get from cash. So cash will be spent to buy power and water, which will be used in the factory. Cash will also be used to pay for labor and supervisors, which will again be used inside the factory. So what do we have in the factory? We have the raw materials, we have the power, the water, the labor, the supervisors, and the goods are being processed. When the goods are completed, they become finished goods inventory. Meanwhile, the accountant will concoct an account called depreciation. They will assume that the building machinery, equipment, furniture and fixtures and vehicles will last a certain number of years. For buildings, perhaps 20 years, machinery and equipment, perhaps 10 years, furniture, fixtures, perhaps 5, and so on and so forth. And as they depreciate all of these fixed assets, the depreciation of the factory may go to the work in process inventory. However, the depreciation of the head office and all the machinery and equipment at the head office will go directly to the operating expenses. There are other operating expenses which the corporations will have to pay for in cash. They will have to pay for the salaries, the supplies, the electricity, and other expenses like travel and representation, rental, and so on and so forth. Notice that there are two types of costs. The cost of making the product, which is the product cost. The finished goods, when sold, becomes cost of goods sold. Then there are the period costs. These are the selling, general, and administrative expenses. So we'll have this product cost and we will have the period cost. Next, ABC Corporation again will pay in cash non-operating expenses, which are really the interest and other financial charges to the bank. Next, ABC Corporation will have to pay cash to the government for taxes. Once the company sells the finished goods to the customers, they become cost of goods sold. In exchange, there are sales coming from the customers. Some customers will pay in cash, so it goes back to cash. Some customers will take credit. They become accounts receivable. And when they finally pay, it again converts back to cash. ABC Corporation might have investments in marketable securities, in which case they may have non-operating income. And this non-operating income comes back in the form of cash. What does ABC Corporation do with the cash? Most of it circulates back to the operation of the company. Round and round it goes. However, some cash will be used to pay the principal of the banks. They've already paid for the interest over there. Some of the cash will be used to pay the suppliers. And again, some of the cash will be used to pay dividends to the stockholders. Remember at the beginning we said that the agreement between the owners and ABC Corporation is that all profits and losses belong to the stockholders. So a way of repaying the stockholders is to get a portion or all of the profits and pay it in terms of dividends to the stockholders. So what we have here in the entire drawing is called a funds flow. Funds going from one container or one circle to another container or another circle goes round and round is called the funds flow, except for this account. This account, called depreciation, is a figment of the imagination of the accountant, and it's really not part of the funds flow. The funds flow is the first financial statements that we have learned today. The second financial statement is on the right side of the board. If you notice, there are sales and non-operating income, which actually enters back to the company. However, there are expenses and costs that permanently exit the company. This entry and exit of funds on the right side of this drawing will translate to the income statement. If the sales and non-operating income is greater than the cost of goods sold, operating expenses, non-operating expenses, and taxes, we will produce a profit for ABC Corporation. If, however, the sales and non-operating income are less than the cost of goods sold, operating expenses, non-operating expenses, and taxes, then we will have a net loss. So the income statement is also called the profit and loss statement. Notice that a summary of the profit and loss statement is either a profit or a loss. That is the second financial statement that we have learned today. There's a third financial statement that we can see from this drawing. It is the cash flow. Just focus on this container or this circle. There are arrows pointing to the circle, or these are the cash inflows, and there are arrows going out of the circle, or the cash outflows. The cash inflows and the cash outflows constitute the cash flow. If the cash inflow are greater than the cash outflows, we have a net cash inflow. However, if the cash outflows are greater than the cash inflows, then we will have a net cash outflow. So the third financial statement we have learned is the cash flow. All the first three financial statements are flows. There is the overall funds flow, which are all the flows of funds coming in and out of the circles. There is the operating flow, which is the income statement, and the third is the cash flow. There's a fourth financial statement. However, it is not a flow. It is a static picture of the company at one point in time. At one point in time, let's say December 31 on X year, and you take a picture of the company at that very moment, you'll find exactly so much cash in the bank or at hand, so much raw materials and supplies, so much work in process inventory, so much finished goods, so much land, building, machinery, equipment inside the company at that point in time. These are called the assets of the corporation as at that point in time. You'll also find at that point of time a certain amount of supplier's credit, a certain amount of bank's loans, and a certain amount of stockholders' equity. This constitute the liabilities of the corporation. Notice that on the right side, we have the assets of the corporation. It's everything owned by the corporation. And we have on the left side, the liabilities of the corporation, or everything that the corporation owes. The assets of the corporation always equal the liabilities of the corporation. And why is that? Because the stockholders' equity takes care of the residual. If the assets generate profits, they get added to the stockholders' equity. If the company generates losses, it gets deducted from stockholders' equity. In the process, assets will always equal liabilities. So the fourth financial statement that we have learned today is the balance sheet. The assets always balance the liabilities. We also note from this drawing that funds go from one container to another. For example, from the supplier's credit container, we get raw materials. From the raw materials, we will convert them into work in process. From the work in process, we can convert them to finished goods. From finished goods to cost of goods sold. Comes in as sales, comes back in cash, and supplier's credit is paid. So notice that there is a sourcing of funds from one container, and there's a usage of or application of funds to the next container. The sourcing and using or application of funds is the financial transaction. So for every accounting entry, there is a source of funds and there is a use of funds. This is called the double entry accounting, which is the basis for the entire construction of the financial statement. Let us now focus on a few accounts of the funds flow statement. These accounts are loan, cash, and inventory. The accountant uses these accounts as containers of funds. The accountant makes one assumption. All the sourcing of funds will come from the right side of the account, and they will enter another account through the left side. Again, they will exit on the right and enter on the left side. So, let's begin with the loan. ABC Corporation borrows 1 million pesos from a bank. So there is an increase in loans of 1 million pesos. At the same time, ABC Corporation increases its cash by 1 million pesos. There is a source of funds from the loans of 1 million pesos and a use of funds in cash for the same 1 million pesos. From the 1 million pesos, ABC Corporation might take out 500,000 from the cash and exits from the right side and puts it in inventory on the left side, which is again a use of funds. So we notice a pattern emerging. The right side of each container is a source of funds. The left side of each container is a use of funds. There's also another pattern which we discern. All increases in liabilities are sources of funds, and all decreases in liabilities are uses of funds. All increases in assets are uses of funds, and all decreases in assets are sources of funds. To summarize, all increases in liabilities and all decreases in assets are sources of funds. They're recorded on the right side of the containers. The technical term given by the accountants are credits. So all entries on the right sides are credits. All decreases in liabilities and all increases in assets are uses of funds. Uses of funds are all recorded on the left side of the container. The technical term for recording on the left side are debits. So the accountant always has two accounting entries: a credit followed by debit, or a debit followed by a credit. If we go back to the drawing, on the top half, we see these three containers. The containers are divided into two, the right side and the left side. This division creates the accountant's T accounts. On the right side are the sources or the credits. On the left side are the uses or the debits. Actually, the accountant prefers a format where the assets are recorded on the left side and the liabilities are recorded on the right side of the balance sheet, contrary to what we presented earlier. The accountant will then create a chart of account. Each account represents a container of funds. In this case, the containers are containers of cash, accounts receivable, inventory, fixed assets, and other assets. In liabilities account, we have the stockholders' equity, short-term debt, long-term debt, supplier's credit, and accrued expenses. These accounts may number to more than 10. They may be 20, 30, or more, depending on the sophistication of the accounting statement. Let us line up all of these accounts and begin to make our financial statements. I'll just go through this very fast with you and later on put the numbers. ABC Corporation will source cash from stockholders' equity, so it gets entered as a source of fund in stockholders' equity and enters cash as the first transaction. ABC Corporation may also get long-term loans and short-term loans from the banks. These funds are again sourced and put into use in form of cash. From the cash, the company may withdraw cash and it exits on the right side as a source of funds. The company may buy inventory and fixed assets and other assets with the cash. The company may also use the cash to pay for supplies credit, to pay for short-term debt, and to pay for long-term debt. So in other words, each of the financial transaction will be recorded by the accountant one by one as a journal entry. Each journal entry is composed of a source of funds and a use of funds. Let us now put some numbers in this financial statement. First, let's source funds from stockholders' equity. Let's get 10,000 pesos from the stockholders. And this is transaction number 1, a source of funds. This is put in the cash account, also for the same 10,000 pesos for the same transaction number 1. That's the first journal entry. The second journal entry is borrowing from the bank 20,000 pesos. Transaction number 2. And this gets entered as cash, also as transaction number 2, for 20,000 pesos. Next, we borrow short-term debt for 5,000 pesos from the bank, transaction number 3, and we also get cash for the same 5,000 pesos. If we add the uses of funds in cash, it's 10 plus 20 plus 5, or 35,000 pesos. If we add the sources of funds, it's 10 plus 20 plus 5, or 35,000 pesos. The balance sheet still balances. Now let's move on to another transaction. The company decides to buy an inventory of goods. Let's say it buys 10,000 worth of goods. So it reduces cash by 10,000 pesos and puts this in inventory for 10,000 pesos for transaction 4. Again, there's a use and there's a source of funds. For the next transaction, we again reduce cash by another 10,000 pesos and we buy some machinery and equipment for the same 10,000 pesos. And that's transaction 5. We may actually spend some money for organizing the company. These are called pre-operating expenses, and they will be entered under other assets. So let's just say we spent cash of 5,000 pesos, transaction number 6, for the purchase of other assets, transaction number 6. We can now be in business. We can now start selling goods. So we have an inventory of finished goods, and we decide to sell half of it. That means to say, we will sell 5,000 pesos worth of inventory. So we reduce inventory, source of funds, by 5,000 pesos, transaction 7. Now, since we sold it, it will permanently exit the company. Where's the exit point? Remember that the income statement is summarized in a profit or loss under stockholders' equity. So what we will do is record it under stockholders' equity rather than a separate income statement. So, this 5,000 pesos gets entered as a cost of goods sold, transaction number 7, for 5,000 pesos. The customer then actually buys it for 10,000 pesos. And these are sales. Let's add the sales to the sources of fund under stockholders' equity. So we will have sales of 10,000 pesos. Transaction number 8 under stockholders' equity. If the customer does not pay in cash, then this gets recorded as accounts receivable or use of funds under the assets column. So we will now have in transaction 8, 10,000 pesos in accounts receivable. Next, we will be paying for operating expenses. So let's just say we paid 5,000 pesos for operating expenses or transaction 9. This gets recorded as operating expenses under stockholders' equity for 5,000 pesos. Notice that we now have 5,000 pesos worth of cost of goods sold and 5,000 pesos worth of operating expenses under uses of funds in stockholders' equity. Finally, we decided to pay 1,000 pesos, transaction number 10, in cash to reduce short-term debt by the same 1,000 pesos. Now, let us stop there and begin to see if our balance sheet will still balance. But first, let us summarize. How does the accountant close these accounts? In terms of assets, the right side must be subtracted from the left side. And you'll find out that the left side will always be greater than the right, because there's no such thing as a negative asset. So, on the left side, we have 35,000 pesos minus 31,000 pesos, or there will be a balance of 4,000 pesos. And that's the balance of the cash account. We will have a balance of 10,000 pesos in accounts receivable. We will have a balance of 5,000 pesos in inventory, a balance of 10,000 pesos in fixed assets, and a balance of 5,000 pesos in other assets. In order to get the total assets, we have to add all of them. So let's add 4,000 plus 10,000 is 14,000, plus 5,000 is 19,000, plus 10,000 is 29,000, plus 5,000 is 34,000 pesos. So we have assets worth 34,000 pesos. Let's look at the liabilities column. Actually, we have sales of 10,000 pesos, plus we have cost of goods sold of 5,000 and operating expenses of 5,000 pesos. In effect, we have zero profit. Zero profit plus the 10,000 pesos in starting equity gives us 10,000 pesos in stockholders' equity. We have 20,000 in long-term debt. Short-term debt will now have a balance of only 4,000 pesos. That's 5,000 minus 1,000 pesos. So let's add all the liabilities to see if they're balanced. 10,000 of stockholders' equity plus 20,000 of long-term debt, that's 30,000, plus 4,000 pesos of short-term debt is 34,000. they still balance. Assets still equal liabilities. From this presentation, we can also discern the four financial statements. Everything that was recorded in all of these containers, everything is part of the funds flow. So all of these transactions are part of the funds flow. We see below the stockholder statement the income statement. Their sales of 10,000 pesos, cost of goods sold of 5,000 pesos, and operating expenses of 5,000 pesos for a profit of 0. That's the income statement. We also have the third financial statement, which is the cash flow, composed of the cash inflows, 10,000 pesos, 20,000 pesos, 5,000 pesos, for a total cash inflows of 35,000 pesos. We subtract the outflows of 10,000 pesos plus another 10,000 plus another 5, and 1,000 pesos, and to get a balance of 4,000 pesos. So there's a net cash inflow of 4,000 pesos. So this container here is the cash flow statement. So we have these three financial statements. We have the funds flow, or all of the transaction. We have the income statement, or the operating flow under the stockholders' equity. And we have the cash flow under the cash account. The fourth financial statement is the balance sheet, which we showed earlier. In the balance sheet, we have an ending balance of 4,000 pesos in short-term debt, 20,000 pesos in long-term debt, and 10,000 pesos in stockholders' equity. This is ranged against the assets of 4,000 pesos in cash, 10,000 pesos in accounts receivable, 5,000 pesos in inventory, 10,000 pesos in fixed assets, and finally, 5,000 pesos in other assets, for a total of 34,000 in assets. So we have seen from this demonstration the four financial statements.